Okay, so this is the third class, equity valuation. If you remember, in the first class, I did sums on economic value added EVA and sums on Alker model, both of which are very, very important for the coming exam. In the second class, we went to the evergreen topic, that is dividend discount model. Okay, quite a variety of sums were there on the DDM. Multiple growth model sums were there. There were also sums wherein a company is present in multiple industries and we had to forecast the profit of the company based on the industry sales, market share and net profit margin. But there was a mistake because we were getting the forecasted EPS E1, but in the second part of the sum, they took it as E0. In the first part, they did it correctly. Hope you have gone through the class. I left out one sum on DDM. I won't like to leave out any sum. So let's start this class with that one sum on DDM first of all. And then we will move to a sum on equity beta, asset beta, debt beta, because debt beta is something which has never come in the exam. As in CA final, we usually believe that debt beta is equal to 0 and therefore we apply that formula. No? Equity beta is asset beta into 1 plus D by E into 1 minus T. But whenever debt beta is given, you can't apply that formula. So many students are not aware of the same. We will do a sum on debt beta, equity beta, asset beta. After doing that sum, we will move to relative valuation, that is sums on price earning ratio, price to book value ratio, price to sales ratio, EV to EBITDA ratio. Okay, so that's the stuff that I think I would like to do in this class. What is it? Number one, a sum on DDM which is left. Number two, another sum on equity beta, asset beta, debt beta especially. And thirdly, certain sums on relative valuation. Okay, that's the agenda of this third class. Okay, let's move ahead. So this is the sheet containing the sums. I am moving to DDM, the last sum that we left on that day. It is question number 16, okay, on my sheet. Question number 16. Here we have a look at the sum. In fact, I'll say this is one of the cleanest sum on multiple growth DDM. If anybody wanted to practice through a clean sum, this is the sum. Nothing great about it. I could have left it. I just took it because I really liked the purity in this sum. An investor is considering purchasing the equity shares of LX Limited, whose current market price is 150. Company is proposing a dividend of 6 for the next year. So 6 is clearly D1, proposing a dividend of 6 for the next year. LX is expected to grow at 18% per annum for the next 4 years. So here interpretation becomes confusing. Next 4 years means what? 6 is already given for the next year. So is it 4 years after the first year? Or do they mean to say that sir, the first year's dividend 6 contains the growth rate of 18 and we have to grow by 3 more years? So I am confused over here. That after the first year, do we have next 4 years growth? Or after the first year, we have next 3 years growth? Got it? Let's see. Growth will decline linearly to 14% per annum after first 4 years. After first 4 years. So they've clearly said after first 4. Here the first 4 means from where we are standing 1, 2, 3, 4. That means the 6th dividend contains the growth of 18%. We have to grow it by 3 more years. 18, 18, 18. So 4 years complete and then 17, 16, 15, 14. Okay. Thereafter it will stabilize at 14% per annum indefinitely. Okay. So from the 8th year we have a stable growth. So the terminal value formula you can apply from the 8th year, that is D8 by RE minus G to get what? P7 and then pull it back, or you may wait 1 year and you may apply the formula P8 equal to D9 by RE minus G and then pull it back 8 years. Okay, that depends on you. Required rate of return is 18% per annum. You are required to determine intrinsic value of the share, whether it is worth to buy the share. The share price was 150. So this is very, very easy stuff. I'm just speaking it out verbally. What is D1? D1 is 6. So 6 into 0.847. That shall be the present value of D1. Next, D2 is 6 into 1.18 into 0.718. That's the present value of D2. Then 6 into 1.18 square into 0.609. That's the present value of D3. Then 6 into 1.18 cube into 0.516. That's the present value of D4. Then 6 into 1.18 cube into 1.17, that's the present value of D5. Then 6 into 1.18 cube into 1.17 into 1.16 into 0.37, that's the present value of D6. Obviously you are feeling bored, you should do it by the table, wherein first column years, second column DPS, third column discounting factor, fourth column present value. This is easy stuff. Now if you take the 8th year and do the present value of D8, it is not wrong, it is perfectly right. But remember, after the table you got to find out P8 equal to D9 by RE minus G. Okay, but if you prepare the table till the 7th year, in that case, after the table, you got to do P7 equal to D8 by RE minus G. This is the place where I think you will get it wrong. Okay, if you draw the table for 8 years, so the present value of the 8th year's dividend is already calculated. So you got to, after the table, calculate P8 is equal to D9 by RE minus G and pull it 8 years back and add to the table answer. Or you calculate the table for 7 years, get the present value 7 years dividend, then after the table, P7 equal to D8 by RE minus G, pull it back 7 years. Please request you, do the sum both ways, you will get the same answer. So that's the sum, and then compare to 150 and you will be able to see whether the stock is overpriced or underpriced. So should we buy the share or not? Okay. Let's look at the institute solution. The institute has done it this way. Normally they don't do it this way. Why should a student do it this way? The table method is better. Years, dividend. Okay. And then the present value, they have done it like this. Why will we do it like this? We will do it in the table itself. Na? Just because they change their presentation, sometimes you can't dance to their tunes. Why will you do it like this? This is stupidity. Okay, they have done the present value of 7 years dividend and then calculated. Okay, then calculated P7 equal to D8 by RE minus G, 17.54 by RE minus G. Okay, so they have prepared the table for 7 years and then calculated P7 equal to D8 by RE minus G. Perfect. Their answer came to 172. The share price was 150. So the share is underpriced. We should buy the share. Okay, we should buy the share. Perfect. Let's just talk about certain variations that can come in this sum. Okay, just 1 second. Okay, listen. Suppose the growth rate in the horizon period after 8 years is not given. They are saying that till the 8th year we'll reach a growth rate of 14%, but after 8 years we don't know the growth. And the question says, what must be the growth rate after 8 years so that the current stock price of 150 is justified? Okay, so we have 6 dividend next year, then 18% growth for 3 years, second year, third year, fourth year, then 17, then 16, then 15, then 14, so 8 years over. Then they are saying what shall be the growth to justify the current price. So that's very easy. You find out the present value of 8 years dividend, correct? You deduct that from the current price of 150, right? Now that the remaining amount that you get is the present value of P8. So obviously you take the growth rate as G for the 9th year. So whatever D8 you got, D8 into 1 plus G. I know D8 into 1 plus G, I don't know. Divided by 0.14 minus G. And the whole thing divided by 1.14 power 8 is equal to, okay, the current stock price minus present value of 8 years dividend. Solve for G. I think you should try even that. Okay, you'll get a very low growth rate after the 8 years. So why don't you do it for us? There is no limit to how much I can do. It is better that these classes be to the point for those people whose examinations are due, so that they don't waste their time. It clicks into their head what I am saying and they do it themselves. Okay. Let's move further ahead. And of course, you have Q forum. Please remember, anything you want to ask, please ask on Q forum. Okay, I think for SFM alone we have around 3,000 plus questions which have been asked on Q forum. So you have a rich database of queries that are coming from students, and they are earmarked quite that liked queries, so you can see any doubt you have. Mostly they are answered only, but still you can ask fresh. There is no issue. Thank you. So let's go to the next question. So I'll go to the next question. 1 second. This was the last sum on DDM. Now I am going to the next question. Okay, 1 second. The mouse is not acting well as usual. Let me see. Okay. Perfect. So now we are coming to that equity beta, debt beta sum. It is question number 8. Question number 8 is a sum on equity beta, debt beta. Okay. Let me just first of all explain to you so that you are conceptually fine. Listen, have a look at the screen. Now here we have the balance sheet of a company, and in the balance sheet you have assets which are financed by equity and debt. We believe CAPM is holding good, so standard deviation is not a relevant measure of risk. Beta is a relevant measure of risk. So we have beta of the asset side and we have beta of the liability side, and both should be equal because the risk of the assets is borne by the liability providers. So but on the liability side you have equity and debt. So we say weight of equity into beta of equity plus weight of debt into beta of debt equal to asset beta. Asset beta is also called the unlevered beta. Okay, because if in the balance sheet we don't have debt, then the asset beta is equity beta, business risk. But if we have debt, equity shareholders have business risk plus financial risk. Okay, this equity beta is also called levered beta, beta L. You know all this, it has been taught in class. Now usually we assume that debt beta is 0. We assume that debt beta is 0. That means there is no risk to debt. If the company has some problem, still it will be able to pay debt and equity shareholders will bear the risk. Okay. So in that case, the formula comes to equity beta equal to asset beta into 1 plus D by E. This is the formula you have normally done in class. So 90% time this is the formula we apply. And of course if tax rate is there, we have 1 minus T over here. Perfect. You know this. However, if debt beta is given, if debt beta not equal to 0, in that case never apply this formula. Do not apply this formula if debt beta is given. Okay, you can't apply this formula. So sir, which formula do we apply? This formula, which is not a formula at all. Okay, this formula, weighted average of the liability side is equal to asset side. Who will call this a formula? This is not a formula, this is common sense. Given this background, let's approach the question. So we approach the question over here. So here is the question. Equity of KGF is 410 crores. So imagine the balance sheet, equity 410. Its debt is 170 crore. Okay, 410 plus 170. Balance sheet 580 crores. Printer division segment's value is attributable to 74%. That means it seems the company is present in multiple businesses. So one of the businesses, the assets that the company has is printer, which has an asset beta of 1.45, the business risk 1.45. Balance value is applied on the spares and consumables divisions. There are two businesses, two dhandas in which the company is. One is the printer division, the other is the spares and consumables. And the spares and consumable has an asset beta of 1.2. So printer division is more risky. Okay, while spares and consumable less risky. The overall risk on the asset side is obviously 0.74 into 1.45 plus 0.26 into 1.2. Okay, it's also saying that debt beta is 0.24. That's the new thing. Usually it is not given. So first of all, without reading the question, I will calculate the firm's asset beta. Okay, assets. The firm has two assets. Number one, the firm has printer. Number two, the firm has spares. Okay, printer, what is the proportion of this business? 74%. What is the proportion of this business? 26%. What is the beta asset of this business? It is 1.45. And what is the beta asset of this business? It is 1.2. So I said no, the spares division is less risky. Okay. Now we calculate the weighted average of these two. So what do I get? I am calculating it on my calci. Today I have no student sitting beside me. 0.74 into 1.45 plus 0.26 into 1.2. That's 1.39. So I'm getting 1.39 as the asset beta. Okay, asset beta. May I take you to the balance sheet again? This asset beta is 1.39. So the beta of the liability side, weighted average, should also be 1.39. Okay, we know equity is 410 crores. So the weight is 410 by 580. This debt is 170 crores. So the weight is 170 divided by 580. We know debt beta 0.24. We know asset beta 1.39. And anybody can calculate the beta of equity. It would be very, very bad if somebody thinks, so why did you do it in a written matter? Weight of equity is 410 by 580 into beta equity. I don't know. I have to calculate. Weight of debt is 170 by 580 and beta of debt is 0.24 given, equal to asset beta, the printer and spares division. So we calculate equity beta. That must be the first question. Yes, you are required to calculate equity beta. Should I show you how ICAI has done? The great ICAI. Yes, they have done it the same way. 1.385, I took it 1.39. Now they have done 410 by 580 into equity beta, 170 by 580 into debt beta is equal to 1.39. And they solved equity beta is 1.86. Equity beta is 1.86. Perfect. Okay. Now, let's look at the second part of the question. Just 1 second. Second part of the question, ascertain the equity beta. Once again, calculate the equity beta if KGF decides to change its debt equity position by raising further debt and buying back equity, leveraged buyback. We are raising more debt to buy back equity to have its debt equity ratio 1.9. So see, we are not raising debt to expand the balance sheet. Okay, we are raising debt to buy back equity. The balance sheet size remains the same, 580. Debt equity ratio 1.9. Assume that the present debt beta is 0.35. They've changed it. It was 0.24. So it seems that if the company is taking on new debt, even the existing debt holders are becoming more risky because they are now afraid whether we will get the money. So it's becoming 0.35 instead of 0.24, which was there in the first part. And any further fund raised has a debt beta of 0.4. So it seems that in the event of the firm's liquidation, the initial debt holders will be the first standing in line, then the next debt holders, so their debt is more risky, and then the equity shareholders whose beta will be very high. So we have to calculate that. So it's very easy. Once again, the whole principle is, now we have three types of debt. Imagine the balance sheet. Those who don't want to do by formula, imagine the balance sheet. Assets, still we have 580. Beta of assets, still we have beta of assets equal to 1.39 because the business has not changed, the printer, the consumable is same. Now we have equity, we have old debt and we have new debt. Okay, the total is 580, we know, total is 580. We have to split, the debt equity ratio is 1.9:1. Okay, so if you split 580, just 1 second, sorry. If I split 580, debt equity 1.9:1. Now that's very simple. Anybody can do that. So debt will come to 1.9 divided by 2.9 into 580. How much is that coming? 1 second. 1.9 divided by 2.9 into 580. That's 380. So debt is 380. And obviously equity is 200. Balancing figure. And this debt 380 comprises of old and new. Old and new. Old is 170 and new is therefore what? New is 210. Perfect. In case somebody says, sir, you did it very fast, please show the board again. This was the balance sheet. If somebody is imagining this, he will feel that this is the easiest sum on this planet. Okay. If somebody is imagining the balance sheet. So 580, debt equity 1:9. I split that 380, 200. Out of 380, existing debt was 170, new debt 210. Now they are telling us the beta. Okay. They are writing that the beta of the old debt is 0.35, I think. New debt is 0.4. I'll just cross verify. 0.35, 0.4, and you remember beta of the asset side was anyways 1.39. Beta of the asset side was 1.39, correct? We just don't know the beta of equity. Beta of equity we don't know. So that's very simple. So once again we have the 200 equity divided by 580. That's the weight of equity into equity beta, which I don't know. Plus the 170 old debt divided by 580 into 0.35 plus the new debt we are taking, that is 210 divided by 580 into 0.4, and all that comes to the old asset beta, which is 1.39. I don't think anybody will have this doubt. So why didn't the asset beta change? Because are you changing your business? The printer division, the spares and consumables? No, you're not changing your business. You're changing the liability side capital structure. So the asset side, the asset risk, the business risk, the unlevered risk remains what? Same. So obviously you solve for it. Please do not complain that, sir, why didn't you solve? Okay, we got to move ahead. Now, let's look at the third part. This is the stupidest question that can come in the exam. Whether the new equity beta, okay, let's check what new equity beta they got, because they got earlier they calculated equity beta was 1.86, but they used more leverage, so equity shareholders are bearing more financial risk, and the equity beta must have been higher. One second, yeah, equity beta is now 3.296. So earlier it was 1.86 equity beta, and now it is 3.296. Okay, it's approximately doubled from 1.8 to 3.296. Whether the new equity beta 3.296 justified increase in the value of equity on account of leverage. What is he writing? Again I read. Whether the new equity beta 3.296 instead of 1.86 justifies increase in the value of equity on account of leverage. What do you want to say? Do you want to say that will the value of equity increase? Because obviously the objective of financial management is shareholders' wealth maximization. So this change in capital structure, is it justified? Should we change this capital structure? Now, if equity beta is going up, cost of equity will go up, ceteris paribus. If cost of equity goes up, we will pull the cash flows at a higher rate, say D1 by RE minus G, and the share price will fall, But obviously it's not so simple. Since debt is cheaper than equity, therefore the cash flows to equity can go up. That depends upon how much profit we will earn in the future. But if we earn a higher profit in the future, cash flows to equity will go up. And if cash flows to equity goes up and we are discounting at a higher KE, there is a fight. We don't know. Nobody can say whether it is good or bad for the company. But prima facie, such a high rise in equity beta from 1.86 to 3.296 suggests that it would be difficult for value creation. Okay, companies taking abnormal financial risk. I would not have been in support of it. So I would have explained this entire phenomenon in the answer, and they would have given me a big zero. Why? Because look at their answer. Okay, convenient answer. Yes, it justifies the increase as it leads to increase in the value of equity due to increase in beta. Kuch bhi. Okay. One tight slap should be given to that person, whoever has manufactured this third question. One tight slap. So you are being unprofessional. Yes, let me be unprofessional, because if they can set such sums and exploit students' understanding and the entire passion for finance, they got to get one tight slap for it. If they do not know finance, they should hire people who know finance, so that people don't have to suffer their shitty stuff which is there. Okay, how can they write this answer? Anyways, let's move to the next question. So if I am moving to the next question, the next questions that I am going to is sums on relative valuation. So question number 5. Question number 5 is on relative valuation. Let's look at the sum. XY Limited, a cement manufacturing company, has hired you as a financial consultant. The cement industry has been very stable for some time, and cement companies SK and AS are similar in size and have similar product market mix characteristics. So we have to value XY, that is the subject company, and the comparable companies are SK and AS. You know that in relative valuation, we try to value a company based on how peer companies are valued. SK and AS. Use comparable method to value the equity of XY in performing analysis. Use the following ratios. Market to book value ratio, market to replacement cost, market to sales, market to net income. So they've given us 4 ratios. Now if an intelligent, commonsensical student will think about it, what are we expecting below the sum? Now for SK and AS, they will give us the market value, they will give us the book value, they will give us the replacement cost, they will give us the sales, they will give us the net income. So there will be 5 data given regarding SK and AS: market value, book value, replacement cost, sales and net income. So you will compute these 4 ratios: market to book value, market to replacement cost, market to sales, market to net income. You will get 2 answers, one for SK, one for AS. Take an average, because if they are not given the weights to be assigned, you take a simple average. So suppose the market to book value ratio, let's check. Market value for SK is 450, book value is 400. So the market value to book value ratio is 450 by 400, 450 by 400, something like 1.125. And 400 by 300 is like 1.33. So 1.125, I may be wrong, I have done it verbally, 1.33. Take an average. Okay, have they done it? Yeah, 1.125, 1.33, average is 1.229. So 1.229 is saying that market value should be 1.229 times book value. Now what is the book value of XY? The book value of XY is 250. So 1.229 times 250. 1.229 times 250 equal to what? 307.25. As per the first ratio, market to book value ratio, the value of XY should be 307.25. I feel all of you who are costing students, who have done so much of overhead, and over there you calculate the machine hour rate, the labor hour rate and all that, for you especially, relative valuation should be the easiest. Okay, because this is the same thing going on. The value of a company is driven by certain drivers like earnings, sales, book value. So we calculate the value as a ratio of the book value and we multiply by the book value. Value as a ratio of sales, multiply by sales. So you'll get 4 different answers and then the average of the 4 answers shall be the final answer. Okay, anybody who is practicing this sum, cakewalk, and they should immediately also do the sum on chop shop approach. Okay, chop shop, the breakup value approach, where we have 4 divisions of ITC, the cigarette division, the paper division, the hotel division and so on, and you accordingly you find out the value of the cigarette division by the multiple method, the value of the hotel division by the multiple method, and there you add all of them, because the value of ITC is the value of the cigarette division plus the value of the hotel division plus value of the paper division plus the value of the FMCG division. That's the chop shop approach. Okay, so you should practice it right away, so that when you are picking up something, if you are picking up relative valuation, you are doing other sums which you have done. Doing means looking at those sums. No need to write and solve them, especially when the exams are approaching. Okay, let's go to the next sum in relative valuation. Just one second. The next sum in relative valuation is question number 9. Question number 9. A company has an EPS of 2.5 for the last year and DPS of 1. So DPS of 1 is D0. D0. Earnings is expected to grow at 2% a year in the long run. Okay, sustainable growth rate. It is trading at 7 times its earnings. It is trading at 7 times earnings. If the required rate of return is 14% RE, compute the following. An estimate of P ratio as per the Gordon growth model. So that's very simple. You calculate the price as per Gordon growth model, D1 by RE minus G. So 1 into 1.02 divide by 14% minus 2%. This is like multiple choice CA foundation. So 1 into 1.02 is 1.02. Okay, some people would like to, sir, please solve it hole. So let me solve it hole. Price of the share is D1 divided by RE minus G. So why are you writing price? This should be intrinsic value. But when we are calculating P ratio as per Gordon growth model, we are taking this itself as price. So 1 into 1.02 divide by 0.14 minus 0.02. You get what? It's 1.02 divided by 0.12. This is 8.5. So 8.5 is the price as per Gordon. And the earnings was 2.5. So P ratio is P by E. So 8.5 divided by 2.5. I am enjoying. Hope you are not, because this is a time wastage. So 3.4 times is the answer. 3.4 times is the answer. 3.4 times. Okay, that's the first part. Second part, the long-term growth rate implied by the current P ratio. Now this time they are use the current P ratio. The current P ratio is 7. So what is the share price? 7 into EPS, 7 into 2.5. The current share price is obviously P ratio into EPS. You must be knowing that there are 2 types of P ratio, trailing and leading. When they say nothing, it's trailing. You multiply it by the current EPS. So P ratio is 7 times, EPS is 2.5. So what is the share price? The share price is 7 into 2.5, which is what? 17.5. 17.5, and this share price 17.5 is equal to D1, which I don't know, divided by RE minus G. You have to solve for G. Do you want me to solve? I don't think you want me to solve. So you can easily solve by cross multiplication. This is 17.5, sorry. Okay, this is the growth rate. So very straightforward question, but when such sums comes, I don't know what happens. People who learn a practice manual without understanding anything, they really get locked up. And institute is nowadays trying to test basics by just reverting the sum, changing data, changing the sum in such a manner that anybody who has ratified the practice manual would be hurt. Let's go to the next question. So we did relative valuation, question number 5, question number 9. There's another sum, question number 19, common sense, where relative valuation is involved. Common sense. Question number 19. Let's look at this sum. Snake is taking over Lizard. Both are listed companies. Okay, so this is actually mergers and acquisition. But you know, mergers is basically equity valuation. So let's continue. Snake is taking over Lizard. The P ratio of Lizard has been as low as 4, as high as 7, and is currently 5. So 3 different P ratios given to value Lizard. So the value of Lizard should be either 4 into EPS or 7 into EPS or 5 into EPS. What is strange is that they have not told us whether this P ratio is trailing or leading. Trailing. If it is trailing, we should multiply by current EPS. If it is leading, we should multiply by next year's EPS. Lizard's previous EPS was 3.4. Okay, previous means current. And the current EPS is 4. Okay, maybe previous, I don't know. They've given 2 EPS, whatever. 3.4 and 4. Determine different range of values of share using P ratio model. They're trying to say calculate as many values as possible. Okay, so we have 3 different P ratio and 2 different EPS. You're understanding how many types of prices are possible? I'm showing you this way. You have 3 different P ratio and you have 2 different EPS. What are the P ratios? The P ratios are 7, 5 and 4. And what are the 2 EPS? The EPSs are 3.4 and 4. 3.4 and 4. 3.4, 4. 3.4, 4. 3.4 and 4. So price is equal to 7 into 3.4. 7 into 4, 28. 5 into 3.4. 5 into 4, 20. 4 into 3.4, 4 into 4, 16. Please calculate the price. These are the range. Such a time pass question is there. Okay. Can it come in the exam? Yes, it can. It does come in the exam. Sir, can we show it this way? Ideally, you should not show it this way. Show some respect to the examiner. Decorate it in a table. Okay, he'll like it. Okay, in Bengali we call it bhalo chele. Okay, good boy or good girl, whatever. So, that is this class where we have done DDM 1 sum, equity beta, asset beta stuff, and we have also done relative valuation. So, 33 minutes. I always feel like completing the class fast so that your time doesn't get wasted. Let's see you in the next class. Okay, bye-bye. Thank you.